Hello, welcome to the TreasuryONE Weekly Technical Analysis Review by Sven Henrik from Northman Trader. It's March 15th, 2020. We had equity crashes globally last week. Obviously, massive impacts on currencies as well. We have a race to the bottom by central banks cutting rates, including the United States Federal Reserve, which already cut by 50 basis points, but is expected to cut again this coming week, which will be a key event in global markets. So let's review briefly where we're at. First of all, understanding the damage that has been done on equities. It's absolutely massive. This was a crash. This is the broader US weekly NYSE index, crashed all the way back to the US election lows of 2016. While we don't see that in the S&P and the NASDAQ, we see it in multiple indices, small caps, banks, transports, and obviously here this broader NYSE index. The DAX crashed to the 2016 lows from all-time highs just recently in February. The FTSE crashed all the way down to 2012 lows. These are major moves, as you are all aware of. And so this is now a big battle of control. This is a broader structure that we've been watching for the last year. This was this big megaphone that broke out on the Fed liquidity runs, and this has now turned into a major false breakout as we not only broke through it, but on the retest failed to recapture this trend line. This was during the time of the Federal Reserve emergency rate cut. And this is a big point now. This is the key question here. Can central banks show efficacy amid this global crisis where we do not have any visibility whatsoever in terms of revenues or earnings? Are we going into a global recession? Yes, we may already be in one, as Europe, for example, is shutting down. The question is the extent, how long, and obviously what that means in terms of future growth. The real challenge, as I see it right now, is that so many people were positioned long here that this move has caught everybody by surprise, even bears, I would argue. And so a lot of people have been so used to any dips being temporary that we now see this buy the dip mentality being heavily punished. We saw Ray Dalio come out this week and say, he completely missed the boat. Obviously, he's one of the biggest hedge fund managers on the planet. Remember here, he was talking about cash is trash. And they were mispositioned, and they're down 20%. So the pain is real, the pain is intense, and what we have seen is systemic selling. We've seen liquidations. We had this big bounce here last week, but obviously we're looking at futures tonight even lower again, but not to the lows yet. So this is a big battle for control, and let me put this in perspective here. Obviously, the Fed came out last week with $500 billion repos, which is unprecedented. They're trying to add liquidity into the market at unprecedented rates. And this is now scheduled to continue until mid-April. So it's very key to see whether the Fed can regain control of the price action. Let's put this in context of the larger technical picture. What has happened here is that we've seen a significant breakdown on multiple trends that go back years in cases. Obviously, we have this larger megaphone pattern that we're now in the middle of. Support last week on Thursday ended up being this trend line here and the weekly 200 MA, and they saved that into the close. This was very important. This was obviously a big rally on Friday, which has still to reconfirm itself. Yeah, we had many of these bounces. What's significant, and I have to really emphasize this, what's significant about the sell-off here, this crash, is the speed and the depth from all-time highs. This is the most significant down move since 2008. This was in the depths of the financial crisis. But keep in mind, that sell-off came after already a year-long process of following the highs in 2007. So there were corrective moves, there were bounces, and so forth that tested support and then tested resistance. We haven't had anything like this before in terms of just a complete flush down. So there's a lot of trapped people here. Not only funds, but retail, everybody that was pushing long here in the early year time frame. So when we do get a sustained bounce, which we expect, because we are currently seeing some of the most oversold readings we've seen ever. Some of it is very comparable to what we saw here. some of it is unprecedented, and that obviously partially explains why we had this big bounce on Friday, just too oversold. But just because you're oversold doesn't mean you have a permanent bottom. You can have a bottom when you're in an uptrend in a bull market, but we're not in a bull market right now. The bull market is broken. The action, as evidenced not only by the price decline, but the vicious back and forth, the whipsawing, is bear market action. So we have to recognize we're in a bear market at this point. So the risk is here that this bounce, whenever it comes, whether it confirms from this low or let's say the next level of support, which is 23.49, which coincides with the December low, this bounce will have a lot of resistance and will have a lot of sellers or longs that want to basically break even and get out. So this will be a major challenge. And if you look at past markets like this, these type of rallies into resistance get sold, and then we have, and this is your kind of global recession scenario, then you can have this cascading move lower into 2020 and 2021 if a prolonged global recession unfolds, which we can't know yet. But this, be clear, this is now a key battle for control for this weekly 200 MA. And so this, hence obviously next week's Fed meeting is incredibly important. Can they defend this price zone or not, or are we heading towards 23.49 first? Because if we do that and do not regain these levels, then you're looking at a market that can head a lot lower here in terms of trendline support. Now, obviously the action last week in currencies was intense, specifically visible on the Bank of England doing their emergency rate cut, immediately pounded the pound, forgive my pun. We have had this bullish pattern on the pound. This was this inverse. We had this bullish flag here, but we also have this trend line resistance, and this has held as resistance very stubbornly here in the last few months. And so now this emergency rate cut has brought us back into this lower range. What does that mean? Well, it means now we're going to need to see the reaction from the Fed. They're widely expected to cut rates very aggressively next week, may even cut them to zero, which may give us a counter reaction here. So this inverse here that we've been looking at is for now broken, does not look good, and that offers risk back to this lower trend line, even into 1972 support. This has been key support for years now. So to me, this remains overall structurally a bullish chart. So if we see a renewed move to here, this would probably be a good entry point, because ultimately we still expect the pound to break out of this larger consolidation phase and head into the 146 area. The euro also experienced obviously a big spike here in the last couple of weeks. We came out of this consolidation pattern. For the euro now is key. Can it hold or defend this breakout? This channel obviously been building for the last couple of years, so it's fairly meaningful. Like the pound is also in a larger consolidation pattern. So all these currencies are heading towards some sort of resolution. All this, we have higher lows and we have lower highs. So something will give, and ultimately to me, is if this trend line here now can be defended as support, then the euro is still ultimately heading higher. Failing to do so gets us back to this lower trend line. So there's a lot of uncertainty right now. Hate to say it. We have a race to the bottom with central banks cutting rates everywhere across the globe. And here's the dollar index. We also saw that spike here, spike lower on the Fed rate cut, spike higher on the BOE rate cut. So this remains a battle for control, also a consolidation phase. We've been in this tight channel now. This channel got saved at the end of the last week. Expect another move next week when the Fed cuts. And so then the question does become, do we drop here on the dollar, right? I mean, if we get a rate cut to zero, this is then here key support 93.94. If that can hold, we are still in this larger structure again that has not confirmed a breakdown or breakout. So key to watch here, the Fed next week. Can this hold, or can this break out towards 103, 104, towards the 2017 highs? The Rand. Well, we have a breakout. This breakout comes with a rejection candle. These rejection candles have to be viewed with caution. The weekly RSI is overbought. When that happens, the rand tends to strengthen. This is what we've seen a number of times here in the last few years. So it has to be viewed with caution in the immediate term. However, the largest structure is very powerful. This is a large consolidation pattern. It's called an inverse, and that inverse has a clear structure here. We have a low here, 11.53. We have the neckline at 15.72. So now that we have this breakout, if this breakout does defend, meaning it can stay above 15.72, then this breakout has a measured move to 19.9 in the long term. And because it is such a long-term consolidation pattern, this tends to be a very powerful structure. So important to watch now with what the Fed meeting, can 15.72 be defended or not? For now, it looks like a clean breakout with this target in mind. Hope that was helpful to everyone. We're looking forward to the Fed meeting next week, and a lot is riding on this. I don't think the Fed can afford much further in terms of sell-offs. They need to show that they still have efficacy and can support the market. Otherwise, we're looking at a serious bear market still to unfold here in the next few weeks. Anyway, hope this was helpful, and thanks for your attention.